We are less than 1 week away from the midterm elections, and investors are understandably nervous. You likely have strong feelings about the economy, inflation, social rights, and abortion, all personal issues on the ballot that absolutely warrant your attention. This uncertainty leading up to the election is often reflected in the markets. Historically, market returns during a president's term are actually pretty predictable. Year one is relatively steady. Year two is more volatile, with a noticeable dip in quarter two and quarter three leading up to an election. And then we get a natural rebound at the end of year two and the start of year three, and then it stabilizes again. Consider it the president's sophomore slump. Regardless of which party wins the midterms or who the president is, for the last 50 years, the S&P 500 has rallied 6.2% in the 3 months following the election and 16.3% in the 12 months following a midterm election. 90% of the time, the S&P 500 has been positive in the fourth quarter of a midterm election year and the following 2 quarters. Schwab's chief investment strategist Liz Ann Saunders explains this post-election outperformance is often driven by the market's expectation of increased government spending. So, are we looking for our impending rally? Not so fast. The historical trends around midterm elections and the markets are solid. Unfortunately, this might just be the year that things are different. Post-election calm will probably help the market, but many agree other key variables will have a much larger impact. Forget the election a week from now. The Fed's interest rate announcement in just a few hours is likely to have even more impact. And of course, the potential for a recession. Ed Clissold, chief investment strategist for Ned Davis Research, talked about the timing of bear markets and recessions. He points out that over the last 100 years, no bear market has ever ended before a recession started. Now, we can argue over if technically we already had the recession, but many agree the potential for a near-term future recession is still very high. If we fall into a real recession, it's unlikely this bear market is over. So even though it's tempting to make investment moves prior to an election, you don't want that to be the primary driver of your decision making. What you can expect is, yes, more volatility. Mentally prepare yourself for wild market swings today and the next few weeks. That's it for this week. This is Jeannie, the 401k lady.